Hey guys, welcome back to another video. This is Lucid Trading. Today we're going to be talking about the stock market before the elections. So, as you guys know, in about 2 weeks, the elections will begin and we will have either Donald Trump or Joe Biden as the sitting president. It is super exciting, and the markets will also be moving huge in anticipation for the election. In fact, I would say this whole move up and down, sideways to the downside was already a massive move before the election. Now, before we get into this analysis, make sure you hit the thumbs up, smash it right now, subscribe to the YouTube channel so you can get updates. And on top of that, guys, check me out on Patreon. Link is in the description. You can get early access, consultations, many other perks are there. So check out the Patreon, link in the description. Let's start with this analysis. All right, guys, so as we can see, the stock market has been moving rather sideways to the downside. You can see we are in a so-called kangaroo market, right? We're moving up and then down, etc. Before we look at what's going to happen in the future, I think it's important to look at the fundamentals. So I've got some tabs right here, and we're going to go through them one by one, and then based off of those fundamental principles, we'll be looking at where the stock market is heading. All right, so we're going to be looking at the S&P 500 PE ratio. If you don't know what the PE ratio is, look it up. No, I'm kidding. I'll tell you. It's basically the prices of stocks divided by whatever the earnings is, or the EPS, right? And so basically, if the PE ratio is above 15, 15 is the median. It's like the average. Now we could consider it that it's rather, it's above average, right? And at some point it becomes overvalued, and you would say that around 20 to 30 could be in overvalued territory or about to be super overvalued. So right now we are at 34.9. Now this number is going to adjust, obviously, because it's based off of earnings and prices, etc. If earnings go up in the future, then obviously the PE ratio will go down, because if earnings, you divide with the earnings. So if earnings are up, you divide with a larger number, we get lower PE ratios. But companies would have to get a increasingly amazing earnings result to lower this PE ratio, which I don't see happening. We could possibly move like 1 or 2 points, but it's still going to be remaining in the 30s, guys. So either prices will have to go down soon, or earnings will have to go up. And if both prices and earnings go down, you know what's happening, right? So yeah, but I do believe we still have some room to go. We can see that in this crash, in the dot-com crash, we went up significantly more. You can see it right there. In the 2008 crash, we went up huge as well. So there's still a little bit space to the upside left for the prices to go up, but I do believe this is going to be the last leg up for the stock market. Now, I want to quickly look at the you can see that the mean is 15.8. We're at 35. Median 14.8, minimum 5, maximum 123. That's insane. So let's go to the Buffett indicator. So what I want to do briefly is look at the GDP versus the total market. So what happens usually is when the GDP goes down, you would see the stock market go down with it. It's a lagger, right? Because the market anticipates the GDP to go down, so it goes down earlier than that the GDP goes down. You could have seen this right here in 2008. The markets already went down before the GDP went down, and you can see we dipped right there massively. And the thing is, we can also do this for the dot-com bubble. But for now, let's just take a look at what's happening right now. So what happened is we had a dip, and then GDP kept on going lower, but the markets pumped. The markets came back to newer levels, newer highs. Well, what happened? Well, you know what happened? This happened. The Federal Reserve pumped all of its reserves into asset classes. They gave stimulus, they gave PPP loans, they gave everything to help the economy, to help also the stock market. And you can see right here that they're still pumping up stocks by buying assets. It's incredible. They're still doing it. This is September 21st, and this is October 5th. They are buying billions of assets, all asset classes. It's incredible, and they won't stop. He said we would do this throughout the year, and they'll just keep on going. But what would happen if they would stop buying assets? That is the question you should ask. What would happen then? All right, so let's go back to the Buffett indicator. So the ratio of total market to US GDP, which is the indicator, right? It's right now it's at 175%. 175%. And we know that whenever the number was 130% is overvalued. 135% is significantly overvalued. Right now we are at 175%. That is absolutely nuts. That is insane. And obviously the GDP is, you can see if you look at the GDP numbers, you can see that they're adjusting it for the year. So it looks like, oh yeah, it's down like 30% for the quarter, but it's actually for the year, so it's down like 7%. But even if you would use the number for 7%, you would still get a massive indicator. The number would still be above 135%. And YouTubers like Meet Kevin, I remember he said something like, yeah, but if you adjust the numbers for the quarter and the next quarter is going to be better, that's not how it works. It's going to actually be better, but it's still, you can't make it better. Like it's still bad. It's still a very bad sign. So even if you would have done that, if you know what I mean. So the ratio is 183.4%, significantly overvalued. You go look at that. We are significantly overvalued. And this is Warren Buffett's indicator. This is the richest person and the best investor in the planet that made an indicator that says, all right, so we're overvalued. We're like significantly overvalued. Sell all your stocks overvalued. So let's go to the next chart. So this chart is the Fed funds and prime rate chart, and you also see the CPI, which is inflation, pretty much the consumer price index. You see that whenever there is a significant crash, we see that the Fed funds rate go to about 0 to help the economy. People get loans for almost nothing. But when the stock market is booming, along with the GDP, then we have higher Fed funds rates. And we see that in 2000 and before that, in the 1990s, we had significantly higher rates. Now, what's the reason for that? What is the reason there? The thing is, we were growing so fast that they could just be like, all right, we're just gonna spike the rates. Why not? We're growing anyway, so let's just spike the rates. And when things go bad, we'll lower the rates. So we'll ease things up, right? And they also have to pay for their balance sheet. So that's why they did it. But we see that the rates right now, for the last 10 to about 15 years, it has been near 0. And then in recent years, the Federal Reserve said, you know what? Let's make them go up a little bit. We can earn some out of this because the economy is growing, right? But that was for a significantly short period of time that they did this, and they're keeping it at 0. And on top of that, inflation is stagnant in comparison to what it used to be back in the day, right? So that is also the reason why that may be the case. That okay, so we will put the Fed funds rate at 0.10%. It will be fine. We're going to help the economy. However, the more people have money, right? Because that's what happens. People get loans. They can get money, and they'll spread it throughout the system by buying things, by creating businesses. The more interest rates will go up, and at some point they're going to have to lower or increase the interest rates, right? And they said they would do this in 2022, right? But the thing is, the stock market prices those kind of things earlier. So if they say, okay, in 2022 or 2023, we're going to rise the rates, they'll go up, they will pretty much, like, the stock market will do this 1 year before we'll start to get priced in. It happens so often. People will price in news already because you buy the rumors, you sell the news. That's basically the principle. And you see the CPI is it's going lower, and that's also due to the fact that production rates of companies and factories are so high right now because of the incredible innovations, etc., that we can lower the prices. It doesn't have to do with the monetary system too much. So, all right, let's look at another graph. So this is like the median home price in the US, nominal and real, right? So you can see that the prices are going up and up and up. Even during COVID, it's going up. You can't see 2020 here. That's very unfortunate. But still, we know that house prices are at sky high levels. And last time they were at sky high levels, we saw a huge dip afterwards. I cannot call the top, I'm telling you. But we're higher. Right now, we are higher than back in 2008. And that is not a good sign because we have a high unemployment rate. The unemployment rate right now is around 8%. What does that mean? Well, that means 8% of the people are not able to afford this housing. Well, the thing is also, I'm going to show you right now. So, wage stagnation, right? That's going to be super important as well. So, the middle class is getting less and less income. So, what do you get if a lot of people in the middle class have less income? We're in COVID crisis, right? There's COVID, people are losing their jobs, and everything on top of this, the wealthy are getting wealthier. That means that the majority of Americans are getting less income to buy houses, but house prices are going up. So what's the reason for this, right? The reason for this is that the wage growth of the top 1% is increasing so much that they can buy up more houses than the median income people. And that's what's happening. Prices are going up despite the fact that the median worker is producing more, but typical workers they get paid less for that produced work. So they're more productive, but the salary is stagnating while house prices are going higher. That makes no sense, right? So at some point, if the 1%, their assets don't go up anymore, if their incomes don't go up anymore, well, what's going to happen to the housing prices? It's going to go down. It's going to go down significantly. What happens when the houses go down significantly? People will be homeless. People won't be able to afford a house. And they'll be cheaper, so people will afford cheaper housing, right? So at the same time, it's going to make the housing. We saw this in 2008. The housing bubble popped, right? We would see the housing bubble pop again, which would mean people would be homeless. People wouldn't be able to afford anything anymore. Consumer confidence would go down significantly because whenever you get a house, you can also buy a car. You're going to buy furniture. You're going to buy many more things along with that house. And if that doesn't happen, that's going to start a negative spiral downwards, which that would be a financial crisis. Now let's go to the manufacturing, right? So manufacturing is significant. It's very, very important because obviously if there's no production, then what kind of economy do you have? So we see that we have had a massive dip. We have a massive dip during March and March, April, etc., May. So that was normal. I think anyone would have expected this. Look at that. That is significant. Minus 19.8% of production. So that's why you also saw in the news, like, oh, there's less pollution in the air. Well, no. Yeah, that's the reason. So, but we see that it's coming back online. So we're seeing that manufacturing is coming back. Although the funny thing is, we can see manufacturing was already negative. I remember this quite clearly. It was already negative before we even heard of COVID. So yeah, we were already going down. That's very interesting, right? So, but yeah, manufacturing is, I guess, it's a little bit bullish. We're coming back down, back up. I mean, so that's nice. That's very nice. Now let's look at the. Obviously, the Federal Reserve is pumping assets like mad. Like they said something around 40 billion assets each month until they think they had enough. So this is increasing, and at some point they're going to have to increase interest rates, and everybody's going to be paying for that. It's literally taking money from the future, and then yeah, well, it's not going to end up good. I'm telling you that. So yeah, so obviously, what is happening with Donald Trump and Biden? What is happening with the elections? So we can see that they polled this. There's 10 days until election day, obviously, about 1.5 weeks. And it looks like Biden is the favorite candidate, right? Biden is this election poll is saying, all right, look at that. Biden is probably going to win, because it's like 51%, 43% for Donald Trump, and Donald Trump is right now in a terrible year with COVID and the markets going down in March. But if we take a look at what happened with Hillary Clinton and Trump were going against each other, the same thing was the case. It was the same thing. The popular vote went to Clinton, the electoral vote went to Trump. We see the same things, and honestly, I have a feeling that the same thing is going to happen like we saw in 2016. I'm not for Trump. I'm not for Clinton. I'm not for Biden. So I'm just looking at it objectively, right? Because what happened in 2016? Well, basically, Trump won, despite the fact that his poll said he would not win. And I want to look at one more thing about the election. Donald Trump has an 80% chance of winning the election, stock market researcher says. So basically what he's saying is that because the past 200 years, when the stock market was booming before the election, the sitting president had an 80% chance of being reelected. And if we take a close look at the stock market, we're still at all-time highs. In comparison to pre-COVID, we're still at all-time highs. We even went to 3,600, which was a very significant number, We can look at March, 1 second. Look at that. We're still higher than when we were before that time. So that's kind of like an indication of that Trump might have the edge, in my opinion, which might result into Trump becoming president again, which would be incredibly good for the stock market. I'm going to show you why. Okay, so would you look at this? This was 2016, back when Trump and Hillary Clinton were doing the elections, right? They were the candidates. What we saw is that we had a bearish run, what we're seeing right now, and then when Trump won, we had an incredible rally from the 2080s to just insane. Would you look at that? Look at that rally. From this point towards, we had a 20% run, even more. From that point onwards, we had the bull rally, the strong bull rally that we right now are enjoying. So if Trump wins, that is most likely going to be another bull rally starting from scratch. I am telling you. So, and we also have to consider Biden winning, obviously, because if Biden wins, I've actually done the research. If Biden wins, there is a high probability that we'll see a 4 to 5% downturn in the coming months, because that's whatever happened when Barack Obama, for example, became president twice, and it happened twice to the stock market. So I'm not going to look at it right now, not too significant, because there's a higher probability, according to the stock market, that Donald Trump is winning. But you never know, right? So what I want to take a look at is where the stock market is going to be heading, right? So let's go to the 30 minutes. So we predicted that we would go up beyond this channel, because we were stuck in this channel like mad, and we can see that we went beyond it, we went above it. We're not now sitting at 465. It looks like we're not going down before the election. It looks like we're going up, right? And we might be going up significantly. However, I would like to warn, every time we went up, we had a downturn. So we might see another correction. I'll draw it out for you. Another correction, probably bottoming at the 446, and then most probably going up again. And I'll look at this. So 3rd of November, right? That is the election day. What would probably happen is we would go up to the 3,500s in anticipation of possibly a Trump win, and then go sideways until the 3rd of November, and then either go down if Biden wins, And got nothing against the guy. He's good long term for the economy, but Trump is just really good for the stock market. If Trump wins, we would go up significantly. Like, I am telling you, if he wins, it is hallelujah for the stock market, right? It's back to the all-time highs. 3,600 at the end of the year, maybe even 3,800. It's gonna be insane. Like, that's basically what it is when when Trump is going to be elected, because he's going to be cutting taxes, he's going to do deregulations, which makes it a bit easier for business to make money, and Biden is going to do the opposite. He's going to increase taxes, he's going to just basically regulate more, etc., which is bad for business. So that is what I think is going to happen. I think we're probably going to be having to look at the 3,475s to about the 3,500s, and then after that we're looking at 3,510, right around that level for next week. That would be my guess, because there's a lot of room left for the MACD to go up despite the short-term correction coming up. And I'm gonna see if I can check this out with the 1 hour and the 4 hours. Obviously, same story holds up on the 4 hour. Same story on the MACD for the 4 hour. Yeah, that's pretty nice. Let's see what the 1 day says. 1 day says we're going to go bearish very soon, which could be, let me just check it out. The bearish candles are insignificant, so this could very well turn into a bullish candle very soon, which we would see a bounce. However, I wouldn't be surprised if we would see a couple red days, obviously, but we could very well go down Monday and then go up again, just like that, before the elections. All right, I think that was this. I think that was the analysis for the election. I hope this video is not too long, but guys, if you enjoyed this video, make sure you hit the thumbs up. I would really appreciate that. Like the video and subscribe to my channel. On top of that, please guys, check the Patreon. It's in the link. It's in the description. Link is in the description. Check it out. You can get early access, consultations, posts, audio posts, exclusive Discord chats and video chats. And on top of that, you'll also be getting buying and selling signals and updates. So check out the Patreon, link in the description. Guys, this was Lucid Trading. I hope you guys have a nice weekend and be cautious, guys. This is going to be one interesting election.